Africa's targeted consumer price inflation slowed unexpectedly to 6.1% year-on-year in February from 6.3% in January. Joining us in studio to drill into the numbers, Etienne le Roux, chief economist at RMB. Very warm welcome to you, Etienne.
Hi, hello.
Well, 6.2 is where RMB was, not too far off the 6.1% that we did receive.
Yeah, a positive surprise. I think the market consensus was 6.4. So financial markets cheered on the news. But once again, let's keep perspective. In level terms, it's still high. We're talking here about inflation of 6.1%. If you're a pensioner, inflation is about 6.8%. If you earn around 1,200 Rand a month, your inflation is almost 8%. If you stay in the rural area, it's 7.5%. Still very high.
That food component really important, taking a look at where that's going, and you were saying that it came down actually downward, and that was actually quite a good progress on that.
Indeed, I think that was the positive surprise. Food inflation actually, prices fell in the month, I think by 0.5% or so. So year-on-year food inflation is about 10%, moderately lower. Still higher than in year-on-year terms, month-to-month, then a positive surprise. I think if you unpack the basket a little bit, you saw price declines in meat, vegetables, fruit, and so on. Once again, there are some concerns when you think about food prices longer term. Bear in mind, in dollar terms, food prices are still very sticky, if not rising again. The maize price also locally still at elevated levels. And then obviously you have to consider the petrol price, which is obviously related directly to the oil price.
One of the things about the petrol price, and we saw it last year, where you had some major oil producers, bringing those stockpiles into the market, and that did sort of, mitigate that high oil price, and there's speculation that could happen again this year. If that doesn't happen, and we do see an increase in those oil prices, and we did see this, at the height of the recession, what the oil prices did when it came to food inflation. Just talk to us a little bit about what that could do.
Oh, it's absolutely critical. You can imagine that oil is a key input in the production of a lot of things. If the oil price stays high, perhaps even going higher over the course of the next few months, it will have a further impact on the petrol price. That will have a knock-on effect on production costs, transport, and so forth. And then also, I'm always very concerned if the petrol price or the oil price is high, the close link with food prices. That's always a concern for me. So once again, it comes back to my earlier points. Food inflation or food prices in the month surprise positively, but if you take it in context of oil prices where it is at the moment, likely to go even higher, I'm worried about food inflation medium to longer term.
Let's just talk about some of the Reserve Bank's concern. One of the things that they have said is when they're looking at the inflation outlook, we're not just talking about the consumer in South Africa, we also have to look at the investment side and keeping that balance. When you hear comments like that, where do you think that the Reserve Bank would like to see those interest rates, or even what their decision could be going forward?
Well, I think monetary policy, if I can just step back, monetary policy is conducted in a very flexible inflation environment framework, and that's very important, which means that the central bank looks at today's inflation, obviously, also the medium to longer term trends, but they also do so in the context of the economy. So growth is considered, as you say, all aspects of growth, consumer spending, fixed investment, so on and so forth. The fact of the matter is that the economy is growing below potential, around 3%. Inflation is above the target, upper limit of the target band, but the central bank forecasts inflation on an 18-month view to be back below 6%. So if you take that into account, considering the fact that they conduct policy in a flexible framework, well, interest rates should not go anywhere.
The Reserve Bank governor's recent comments, she was talking about how Europe is still a really big issue when you're talking about growth in South Africa. And just looking at the markets generally, they're saying, what is the next country that we're going to be dealing with? And you also have to remember that Greece wasn't the only country that was that is in in crisis right now. Absolutely. So how big an concern would that be when it comes to the Reserve Bank, looking at that 18 months that you're talking about and going forward?
Absolutely. I mean, South Africa is a small, open economy, so it really matters what happens globally, particularly in Europe. And as you rightly point out, Greece has been in the news, but who's to say that Portugal is not the next economy that's going to suffer? From a growth perspective, the trade and the financial linkages between SA and Europe is quite strong. Those are quite strong linkages, and it hence it matter what goes on there. The governor has been talking about the uncertainties not only in Europe but also globally, and here we're talking about oil also being a big uncertainty. Who knows, maybe it can go to $130, $140 a barrel. So in all of that, it is still an uncertain environment thinking about local growth prospects. I've made the point before, the economy is growing at 3%, not much more than that. So it's still not strong enough for the Reserve Bank to kind of create a comfortable situation on the growth front. So with an economy doing that pace of growth, it's hardly any reason for the central bank to tighten policy.
Well, when we look at consumer confidence, though, the South African consumer appears to be a little bit stronger than they were, you know, previously, even if we look at last year, for instance, and the South African consumer really important for that growth. So we're talking about local growth. Can we depend on the South African consumer right now to kind of mitigate what's happening in the rest of the globe?
Well, we taking a little bit more of a cautious view on the consumer. The consumer up to now has been very, very strong, driving the economic upswing. Upswing is 2.5 years in the making. But if you consider things like ongoing increases in administered prices, if you consider things like the CPI inflation we're talking about today, high and rising over the next few months still, and if you think about, at least in our opinion, that when you think about wage inflation, income growth, it's very difficult, at least in my opinion, to see that we're going to repeat the double-digit increases in wage inflation that we saw last year and the year before. So if you think about a modest or deceleration in wage inflation, still decent, 8% or so, but not 10%, and you play that off against the fact that inflation will still be going up, real income growth ultimately is what matters. For me, there's pressure, and I don't think that the consumer will continue to spend at the same rate that we've seen over the last two years or so. So it doesn't mean that the consumer or that growth, real growth in consumer spending is going to slow down dramatically. We're still talking 3.5%, maybe 4%, but not the 5 and 5.5% we've seen before.
I want to ask you very quickly, Etienne, market seems to be pricing in higher interest rates by the end of the year. Your forecast for 2012?
We still think that the next move in rates is up, but not as quickly as the market anticipates. We think that the next move will be up, say, mid-2000 or the second half of 2013. So the prospect of rates staying flat for a little bit longer.